I think the U.S. consumer is walking towards a cliff. That's a sobering assessment from Chris Watling, CEO of Longview Economics, who believes much of what we have been seeing in the way of robust consumer spending is a mirage. Before we begin, remember to like this video and subscribe for more economic updates. The recent uptick in retail sales is real, but according to Chris Watling, it's where the money is coming from that suggests the economy is not as strong as the spending numbers might imply. Retail sales have been strong for the last few months, and everyone gets quite excited about that. But actually, if you look at what's going on, the household savings ratio has been run down, and in fact, real income growth has been negative for 3 months. You may have heard that GDP in the third quarter grew at an unexpectedly strong annualized rate of 4.9%. That's more than double the 2.1% growth rate posted in the previous quarter, and it's the fastest rate of growth since the fourth quarter of 2021. The single biggest driver of GDP growth last quarter was the American consumer. Consumer spending was responsible for 2.7 percentage points, or 55% of the GDP growth rate. But as Watling points out, real income growth, which accounts for inflation and taxes, actually fell in each of the 3 months that made up the supposedly strong third quarter. Watling sees the plummeting personal savings rate and concludes that Americans might be on the verge of running out of discretionary cash. 2.5 years ago, the savings rate was slightly more than 26%. As of September, it was down to just 3.4%. Researchers at the Federal Reserve Bank of San Francisco recently anticipated that the $2.1 trillion in excess savings accumulated by Americans during the global health crisis would be depleted sometime in the third quarter. Now it seems consumers are telling us that they're cutting back on spending and plan to continue cutting back through the end of the year. According to a recent CNBC Morning Consult survey, 92% of adults say they have reduced their spending over the past 6 months. The survey also revealed that more than 3/4 of all U.S. adults plan to decrease spending for non-essential goods and services over the next 6 months, and more than 60% plan to cut back on essential goods and services over the same period. Recent signs of consumer spending slowdown include major toy maker Hasbro, known for its iconic brands like Play-Doh and Monopoly, revising their sales projections downward. Hasbro said it now expects a decline in revenue by as much as 15% for the year. That's a considerably bigger drop than the 3 to 6% decrease originally expected. Hasbro's CEO Chris Cox said during the company's recent earnings call, "We have a cautious outlook on the holiday. We do not have a real solid view on where the market will go." Listen, there may be no better commentary on the current economic uncertainty than the fact that one of the world's largest and most iconic toy brands can't be optimistic about sales prospects over the holiday. Referring to vigorous consumer spending activity, Longview's Chris Watling said, "It's not quite all good news. I mean, quite the reverse. I think there are some real challenges coming for the U.S. consumer." If Monopoly money can't get Hasbro through these hard times, maybe we should be a little concerned too. We'll be keeping a watchful eye on this story, so stay tuned for more updates. Until next time.